Now, the timing really matters. The 24th of July closure date lines up with the SGE-connected Hong Kong gold clearing system full launch. Now, it's not a coincidence. China and Russia are moving toward gold-linked monetary frameworks that reduce dollar dependency. And it places a hard asset floor beneath the yuan and the ruble. China and Russia's shift back towards gold and linked monetary systems as physical gold migrates towards yuan ruble linked Hong Kong and expanding global SGE corridor, which is going global, the dollar-based paper system loses control of marginal prices. In that environment, synthetic dips become accumulation opportunities, with any failure by paper shorts to access physical supply triggering a disorderly upside repricing. That is imminent. So from next week's liquid launch through to the end of 2027, liquidity providers assess a dollar gold price between 10,000 and 12,000 and 5,600 by the end of 2026.
The alignment of the July 24th closure date with the full launch of the SGE-connected Hong Kong gold clearing system marks a major turning point in global macroeconomics. China and Russia are actively moving toward gold-linked monetary frameworks specifically designed to bypass Western financial networks and drastically reduce their reliance on the US dollar. Andrew Maguire, a prominent wholesale gold broker, asserts that this shift places an unbreakable physical asset floor beneath the yuan and the ruble. With this structural realignment, he projects that paper shorts will face an imminent delivery squeeze, propelling the gold price to $5,600 per ounce by the end of 2026, and eventually between $10,000 and $12,000 by the end of 2027. As the dollar-based paper system loses its grip on marginal pricing, these emerging hard asset frameworks will redefine global wealth preservation. Now, we present the clips from his interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
China and Russia are moving toward gold-linked monetary frameworks that reduce dollar dependency. And it places a hard asset floor beneath the yuan and the ruble. Now, there'll be a fix that better represents true physically settled supply-demand price. It's going to incentivize global institutions and commodity buyers to begin treating that exposure as credible collateral. That means you buy the ruble, you're getting gold. Buy the yuan, you're getting gold. It's exchangeable. The market will be forced to reprice not only gold, but the risk embedded across the dollar-based fiat system. Russia's gold convertible ruble really it's a push forward here. They've allied themselves with China. This is not a coincidence. It reinforces the setup. And for commodity buyers, ruble exposure becomes a cheaper proxy, really for gold-linked collateral right now. And it's driving dollar selling to fund that exposure. And this is the kind of flow that can tighten dollar liquidity, lifts metals pricing, and force a rapid repositioning across what is a gold-linked foreign exchange exposure. And as markets price China and Russia's shift back towards gold and linked monetary systems, and as physical gold migrates towards yuan ruble linked Hong Kong and expanding global SGE corridor, which is going global, the dollar-based paper system loses control of marginal prices. In that environment, synthetic dips become accumulation opportunities, with any failure by paper shorts to access physical supply triggering a disorderly upside repricing. That is imminent. Let's start by summing up July's action, though, as far as it reveals the gold buy signal that institutional central bank and sovereign buyers have been waiting for, which is China stepping in to shield the domestic speculators from the disruptive influence of massively leveraged Western-centric COMEX derivative sellers. Now, to do this, the PBOC forced Chinese speculators into a sell-only mode, which is why we had noted that Shanghai spot was trading at a discount to London during the main sessions, which was most unusual. But into each fix, the tape flips and Shanghai snaps back to a premium at the AM and the PM, T+1 delivery fixes they are. And that is where the PBOC footprints are the clearest. Sharp premiums over London at the T+1 fixes was immediately followed by discounts snapping back once normal trading resumed. So the clues were all there. We kind of went through them last time, but completely unseen by the paper-centric Western market activity that we've been tracking. The PBOC remains the only visible source of consistent Chinese physical demand. Now, they've been accumulating gold in an extremely disciplined and a systematic manner. And as we said, 3 to 5 tons per day, every day. These footprints are most clearly reflected in the Shanghai fixed premiums versus London. Now, at the same time, 400-ounce London bars continue to be withdrawn from the system, partly to meet PBOC monetary gold demand and partly to support physical liquidity requirements following last Tuesday's trial launch of the Hong Kong Gold Exchange. Now, while no official launch date has been announced for this next in the series of SGE Gold Corridor Gateway rollouts, as we outlined last time, our well-connected liquidity providers are preparing for the next week's 24th of July trading bank shutdown of the remaining sell-only Chinese speculative accounts. And a lot of the swap dealers were having a difficulty getting out of those positions. And what it was doing was signaling that unencumbered physical liquidity is being readied for the next batch of 400-ounce bars moving from London to Hong Kong. This is all about China putting the yuan on the gold standard. Now, the timing really matters. The 24th of July closure date lines up with the SGE-connected Hong Kong gold clearing system full launch. Now, it's not a coincidence. Now, we can absolutely be sure that the White House is watching this data very, very closely. And China now has the infrastructure required to challenge the entire COMEX LBMA price setting regime and effectively greenlight a global central bank revaluation event. This is a date to watch. Now, this may be one of the most bullish structural events in gold market history because it builds an Eastern clearing physical settlement pricing and delivery architecture outside the traditional London-New York axis. And because of that structure being in place, they've been able to control not only the price, but they've also been able to control diluting that price. By linking Hong Kong directly with the Shanghai Gold Exchange and a hugely expanding vault capacity, in collaboration with Bloomberg launching of a regional HAU physical price, that's a price reference set in the Hong Kong Physical Exchange. What that does is price physically deliverable RMB futures contracts that exposes local London COMEX diluted XAU price references. And given that foreign exchange gold is actually NSFR compliant and T+1 deliverable at the London fixes, the HAU XAU arbitrage process will close that paper to physical gap far quicker than people can imagine. Now, the PBOC has also removed restrictions and they're allowing gold for the first time ever to flow freely between Shanghai and Hong Kong, which is global facing, which makes this the most liquid global gold exchange. Like that, the HAU price enables institutional, physically deliverable over-the-counter settlement, which telegraphs that China is creating the plumbing for physical gold to be priced, financed, and mobilized in Asia, and then ultimately globally. Now, for gold and silver investors, the significance is it's not simply another trading venue, which many people have think, it's just one more trading venue. there's still going to be gains. No, it's not.
Global institutions and commodity buyers are beginning to treat these emerging Eastern monetary exposures as highly credible collateral. Purchasing the ruble or the yuan is increasingly becoming synonymous with acquiring physical gold, as these currencies become seamlessly exchangeable. This paradigm shift is forcing a massive global repricing of the embedded risks within the dollar-based fiat system. Because the Federal Reserve remains heavily short on gold it cannot physically deliver, a forced revaluation of U.S. Treasury gold is becoming mathematically inescapable to avoid a systemic default. Liquidity providers are already factoring in this reality, projecting a gold price between $10,000 and $12,000 per ounce by the end of 2027, as the paper-to-physical gap closes far quicker than the market anticipates. Any synthetic price dips in the near term are merely golden opportunities for accumulation. Now, let's get back to the interview.
But while near-term volatility from rates, the dollar, or positioning may pressure gold tactically, and it has been, the strategic setup remains constructive as central banks, sovereign buyers, and Asian institutionals continue to prioritize gold as reserve collateral. And masked by the volatility generated by this 100-to-1 leveraged, deliberately constructed synthetic death cross that we looked at last time. We'll probably look at it in the charts again in a minute as a reminder. But what we looked at that last time, the real action actually remains firmly in the physical market. Liquidity providers continue to report heavy institutional demand beneath the surface, reinforcing a clear buy-the-dip bias as gold builds above newly anchored physical support. And the broader trade remains intact, though, so it hasn't changed at all. But liquidity providers report that safe haven gold accumulation has in fact accelerated, with buyers taking advantage of dollar strength, clearly, against gold, while prices remain synthetically capped, setting the stage for a nearby repricing of gold's role within an emerging RMB-linked, physically backed financial system. Bottom line, the paper market may still be managing the optics, but the physical market is really telling a different story. Institutional demand is tightening beneath the surface, and any near-term weakness is increasingly being viewed as an opportunity to add exposure before gold's structural revaluation becomes impossible to ignore. And while gold price revaluation is a process, structurally it's reached an inflection point where more 100-to-1 unbacked paper ounces of COMEX contracts are actually being called in for physical delivery, more than can be delivered. This then becomes an event. And to avert a force majeure failure to deliver, the only central bank still short gold that it cannot deliver, the Fed, will be forced to revalue massively rehypothecated $42 per ounce US Treasury gold to the market price to balance the book. True supply-demand fundamentals dictate this is an inescapable event to come. There's just not enough immediately deliverable above-ground bullion for the Fed to simply buy its way out on scale at any price. And that leaves one viable exit, a paper gold revaluation from $42.22 per ounce to the market price. Given the lack of auditable data on the extent of multiple ownership claims against US Treasury gold, the amount that would actually have to be squared to revalue, it is speculated as to estimate what that revaluation price is. However, at an absolute minimum, the required revaluation would likely have to, even from current levels, would have to be somewhere between 6,000 to 8,000. And once revalued, and gold strengthens the asset side of the sovereign balance sheet, the Fed will be better incentivized to join every other global central bank and, just like the PBOC, seek a steady gold price appreciation protocol. And looking at the newly anchored support, at 100-to-1 leverage, the Fed has thrown everything at gold. Paper supply has been used to manufacture a well-telegraphed death cross, which is basically where the 50-day moving average crossed through the 200-day moving average. And that successfully baited and hooked the latest wave of naked shorts into this capitulative breach of central bank support at $4,000. Now, in a normal market, that setup might squeeze out another 3% of downside from the cross, which was at 39.66, likely targeting 38.50, which would have been that 3% move. But this is not a normal market. Every official sector buyer now sees gold weakness into dollar strength as an inventory accumulation opportunity. As we looked at a couple of weeks ago, the last comparable setup when we saw a cross like that was right here. And that was the 27th of September through to the 6th of October 2023, when gold was pushed down 3.4% from 1900 to 1835. Then came the snapback. On the 1st of December 2023, the Golden Cross triggered a 5.4% one-day surge from 2,035 to 2,144, before an 8% retracement into a perfect bounce on the 50-day moving average. I'm just trying to show you basically how synthetic this action is. Has nothing to do with physical supply and demand. The key point, though, taking that point, the entire synthetic 3-month wash and rinse cycle had set up a physically driven higher stair-step, similar to the 184% rally triggered by the PBOC's March 2024 Shanghai Futures Exchange launch. Now let's look at the PBOC's footprints. Again, into the end of June BIS squaring low, which was a 30% discount from 5,600 to 39.4175 spot gold, this wash and rinse cycle that we've been observing has reached another unfactored PBOC physical initiative, and this is 100% physically driven. And much as we saw from the Shanghai Futures Exchange launch into this bottoming action, it's set to blow shorts out of the water into what is actually a very wrong-footed shrinking pool of bearish open interest. Now, the launch of the physically determined HAU gold price will exceed the unfactored effect on price that the 184% Shanghai Futures Exchange rally had on gold, which was from here just to here. So from next week's liquid launch through to the end of 2027, liquidity providers assess a dollar gold price between 10,000 and 12,000 and 5,600 by the end of 2026.
The Western paper market continues to manipulate price optics by manufacturing synthetic death crosses, but the physical bullion market tells an entirely different story of extreme tightening. Under the surface, central banks and sovereign buyers are aggressively accumulating physical reserves, viewing every artificial price dip as a prime buying opportunity. The historical parallel of the massive rally triggered by the Shanghai Futures Exchange launch in early 2024 is set to repeat on a much grander scale. The newly launched physically backed gold pricing architecture in Hong Kong is structured to completely bypass the traditional London-New York axis, exposing heavily diluted Western price references. This structural squeeze leaves only one viable escape route for Western central banks: a massive official revaluation of paper gold to align with actual physical market realities. Experts predict this inevitable transition will easily propel gold to $5,600 by the end of 2026, ultimately scaling to a trading range of $10,000 to $12,000 by the end of 2027 as the fractional reserve paper gold system collapses under the weight of physical delivery demands. By establishing a direct link between physical exchanges and regional pricing, Eastern markets are quietly rendering the paper-dominated COMEX system obsolete. Investors who recognize this shift now can secure their positions before the physical supply completely dries up. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.